how to pay off an $800,000 mortgage in 18 years instead of 30 with the same cash flow when you don't even have access to a line of credit. Here's a creative solution that I discovered with a client of mine. Hello everyone, my name is Sylvia and I'm a financial landlord consultant. I work solely with landlords to help them save money, save taxes, and pay less interest to the banks. I'm also known as the cash stemming queen. If you love my weekly training, please comment, please love, please like, please subscribe to my YouTube channel to encourage me to make more of these weekly trainings. So today we are going to talk about a client of mine who came to me and they're like, Sylvia, I really want to start rental cash stemming, but I don't have a line of credit. I don't know how to get started. So let's just back up a bit. Let's talk about what we need to make rental cash stemming work. To make rental cash stemming work, we must have access to a line of credit. But this is not any line of credit. It must be a line of credit that is re-advanceable. Most of the 5 big banks offer re-advanceable line of credits, but I'm telling you, they're not all the same. Refer to my other training on which lenders work and which ones don't. But remember, the 2 big ones that I keep on saying no to is no to CIBC and no to RBC. So let's back up. Let's talk about the ultimate result of rental cash stemming. The ultimate result of rental cash stemming is to pay off your primary home mortgage earlier than planned. So why do we need a line of credit? Well, this is how rental cash stemming works. You take your rental income, let's just call it $3,000, and you pay down your primary home mortgage first. And then you take advantage of the features within a re-advanceable line of credit and use the line of credit to pay for the rental expenses. Essentially, you're turning bad debt into good debt. Now, refer to my webinar, cashdam.ca, cashdam.ca for more information. Now, when you run the rental cash stemming strategy properly, you will attain mortgage freedom much faster. But the cool part about attaining mortgage freedom from going, say, from 30 years down to 18 years is you don't have to bring out extra money out of your pocket. So fast forward to 18 years, you're mortgage free. What would you do with that extra money? Imagine not having to make mortgage payments anymore. What would you do? Most of my clients will say travel. So how did I help this one client? This client owned 2 properties. One primary home mortgage, which they just moved into, and one rental property. The client's rental property used to be their original family home. So they didn't sell it. What that means is when they moved into their new home that they're living in right now, they only had the bare minimum 5% down payment because they didn't sell their current rental, where they used to live. So can you see what the issue is right now? We have a primary home that had only 5% equity in it, and then we have a rental property that we're renting it right now. For us to get a line of credit on our primary home, we must have a minimum of 20% equity. For them, they only had 5%. So what are some options for this particular landlord who has a primary home with only 5% equity and no re-advanceable line of credit? So option number 1 is they can wait 5 to 10 years during the slumped Canadian market and hope that they'll get to that 20% equity in the next 5 to 10 years. Or they can work more hours at work or pick up a second job or become self-employed and try to find some more money and make extra lump sum payments towards their primary home to build up that 20% equity. Or they can work with me. Using my skills as a mortgage agent for the last 20 years and a landlord myself, and also someone who rental cash stems, I will create custom plans for my clients to set them up for success to pay off their primary home mortgage 8 to 12 years earlier. Rental cash stemming sounds very simple from a high level. But I'm telling you, it is not a plug and play. You don't just plug it in and your iPhone will work. It's very specific planning and action steps to make it successful. So what do we do with this particular client? Since their current rental property used to be their primary home, they had a lot of equity in the home. Let's just say their rental property is worth $500,000. They had a $200K mortgage. They had $300,000 of equity sitting in this property. So what did we do? We refinanced their rental property. Yep, we broke the mortgage. We paid a penalty. We refinanced it so we could tap in to that equity that's sitting in that rental property, not doing anything, not creating wealth for my client. And we use that money to pay down our primary home mortgage. And then now that our primary home mortgage that used to only have 5% equity has now 20% equity, we now have access to a line of credit. When it comes down to pulling out equity from a rental property for personal use, it's extremely important that you keep the mortgages absolutely separate. You cannot combine the current mortgage on the rental property with the equity takeout that you're using for personal use for your primary home. Because once you combine it, and CRA finds out, and they will find out, they will disqualify you from the entire, not only the rental cash damage process, but from the write-offs on that rental property. You can't write off the interest costs on that rental property. And that's huge because your biggest write-off on your T776s is the interest costs on the mortgage on the rental property. But if CRA deems that that mortgage has been contaminated with deductible and non-deductible debt, with good debt and bad debt together into one, they can deem all of the interest costs non-tax deductible. And now you're going to pay even more taxes to the government. So what do? We refinanced their rental property. We pulled out equity from their rental property. We kept it as two separate mortgages, good debt and bad debt, deductible debt and non-deductible debt. We took that money, we paid down our primary home mortgage so that we can activate the proper re-advanceable line of credit. And now my client is off to paying off the primary home mortgage. Instead of 30 years, they had an $800K mortgage. Instead of 30 years, they will pay off that $800K mortgage and the line of credit that they created in rental cash damage in 18 years. They shaved off 12 years off of the mortgage. And the coolest thing is, it didn't require them to bring out any extra cash out of their pocket. All it required for them to do is to have the courage to keep the current property, not sell it, buy another property, and have the proper structure in place. If this sounds like you, where you had an original home, you turned it into a rental property, you went to go buy another property for your family to live in, and now you own two properties, one owner occupied and one rental property, and that owner occupied doesn't have enough equity, therefore in your mind you're like, oh, I can't start rental cash damming, come talk to me. I'm here to help you. Comment, show me below, and I will send you a link to book a time with me where we will look at creating a customized plan just for you to show you how to pay off your primary home mortgage faster. Thank you so much for listening, my friends. My name is Sylvia Ho. I'm a financial landlord consultant. I'm also known as the Cash Damming Queen. I work only with landlords to help them pay off their primary home mortgage 8 to 12 years earlier than planned, how to retire mortgage-free, and to enjoy life. I will talk to you next week, my friends. Bye now.